Hey everyone, thanks for checking out Adventure Story number 2. In this week's Adventure Story, we're going to be doing a webinar with Joshua Bowman from the Sherin and Lodgen law firm. He's going to be reviewing the CARES Act with us. There's a lot of questions and a lot of information that seems to be constantly changing. So this week, we thought this webinar, we've been kind of rushing to get it together. Joshua's just been really generous with his time. He chairs the firm's hospitality practice group. So, he's an expert in this. And he's also joined by one of his partners, Joe Schulman, who's an accountant who can talk about all the tax relief and a few other accounting things. So thanks for watching this video. Please stay tuned at the end. Next week we have kind of a fun one. We're going to be interviewing Colleen Hudson. So stay tuned for that one and reach out if you have any questions. Thanks for watching.
This is a presentation that I put together with Joe Schulman, who should also potentially be joining us today. And Joe is a CPA with Citrin Cooperman. They've got about 130 accountants in the Northeast, and his colleague Jay Pike helped out. Jay's not going to call in today, and then Michael Kuhn was a Cambridge Savings. He's a Cambridge Savings Bank, and he's an SBA lender. So I'm going to talk about the CARES Act, specifically the PPP, the Paycheck Protection Program, the EIDL loans, the unemployment insurance benefits, and then Joe's going to help out with some tax benefits. So those are the three areas I'm going to cover. But in addition, I just wanted to make everyone aware that at Sherin and Lodgen, we've been working on a number of issues. One is business interruption insurance for hotel owners. And one thing that we learned was that there really is no business interruption insurance for hotel owners and restaurant owners because, sorry, Joe was just trying to call me. So there really isn't any coverage because there was a virus exclusion that was added into the ISO standard insurance policy documentation back in 2006, I believe, after the SARS viral epidemic. The insurance industry realized that something like COVID-19, it wasn't a question of if, it was a question of when. So they decided right then and there that they were not going to take on the risk for COVID-19, and so they excluded losses resulting from viruses from their standard form insurance policies that basically are in effect all throughout the country. So in Massachusetts, I helped to write a bill that has been introduced into the Massachusetts legislature. Right now, we have 34 co-sponsors after a week. And the bill is intended to create a bailout for a state-sponsored bailout of the hospitality industry using the insurance industry as a conduit. So we're not saying the insurers are the bad guys. We don't think they are, but we think that they can certainly help out more than they are with this current crisis. So it really mandates business interruption insurance, but it allows the insurers to get reimbursed by the state. So I'm happy to answer questions about it. There are similar bills that have been filed in New Jersey, New York, Ohio, and then last I checked, Pennsylvania and California are both looking to file similar bills or to have executive orders to do basically the same thing as what my bill does. So anyway, without further ado, there's the unemployment expansion, there is the tax credit and relief, and then there are two programs called PPP and EIDL. Those are the PPP and EIDL are the programs that have the most interest from the hospitality industry. So briefly, just to go through what they are, PPP is the Paycheck Protection Program. It is using the banks as a conduit for all this government money, and the money is going through the existing SBA program. It's the 7A program. Many people may already know the 7A program has been around for a long time, and so what the SBA is doing is they have $350 billion, and they're funneling that money to SBA lenders, which are basically community banks. So the SBA basically gives the money to the local community banks. So who's eligible for the PPP? So it's generally businesses with 500 employees or fewer. You have to look at the SBA regulations to see, for different industries, there's different sizing requirements. But for hotels, they've limited it to 500 employees per location, which is a terrific change in the regulations, because usually there's something called co-employment and joint employment, and they look at everybody's employees together. If you have 5 or 6 different ranches, they would look at them all as one business for the purposes of the SBA. But for the PPP, they're not doing that. It's 500 employees per location. So if you have 4 or 5 hotels or ranches, resorts, whatever it might be, you can apply for 4 or 5 loans for each one. Okay. If you're an LLC or you're a corporation, or you're a sole proprietor or an independent contractor, or if you're self-employed, which is again a terrific feature of this program, because usually for an SBA loan you're not considered a business if you're a sole proprietor. Here you are. The affiliation rules, like I mentioned, are all waived. Basically anyone can apply. So how do you basically get the money? Well, the money comes in the form of a loan, but do not let that, mislead you. Most people who apply for this are looking to get a loan that is then forgiven. And so in that sense, this is a grant from the federal government. This is essentially free money from the federal government if you follow their rules. Now, unfortunately, this program is terrible for the hotel and restaurant industries. It's terrific for a law firm like Sherin and Lodgen LLP, and the reason for that is that at Sherin and Lodgen, thankfully, we have not laid a single person off yet. Okay, we hope to not lay anybody off. But for a hotel or a restaurant, most of my clients who own hotels have laid off significant numbers of employees already. And the PPP, in order for the loan to be forgiven, which means you don't have to pay it back, you have to maintain your same or close to your same level of headcount. And if you don't, then that loan does not convert into a grant. It remains as a loan. So I'll explain that in greater detail. But again, this is terrible for the hotel industry, and it's why people like myself are still pushing for a business interruption insurance to step in, or really for another round of stimulus from the federal government would be completely fine with me. But the reality is that this is terrible for the hotel industry. So the way that you get the loan, which again you hope is going to be forgiven, is that all you have to do is certify certain things to the SBA lender. You have to certify that the loan is necessary due to the uncertainty of the current economic conditions caused by COVID-19. You have to acknowledge that the funds are going to be used to retain workers and to maintain payroll. And you must not have another application for another loan with the same borrower. You can't do it more than once. And then I don't know if it's on this slide or the next one, Steve, but you have to be in business by February 15th. Okay, so as long as you're in business from February 15th on, you're eligible for this loan. Now, I've been looking at these notes. A lot of clients of mine have been applying for these, and the notes actually say there's a representation and warranty from the borrower that you're going to maintain at least 90% of your workforce. I have no idea where they're getting that 90% number from. It's not in the CARES Act, but I looked at some documents from one of the largest lenders in the country, and that's what the note said. So I'm just looking at some of the chats here. Please explain how you apply if you are seasonal. The vast majority of our expenses in the summer months, the 12-month average actually cuts over our loan amount way down. I just see Joe Schulman is joining the call. Joe, are you on the call? Yep, go ahead.
So there was language in something about seasonal tight payroll, but if you compare it to the restaurant industry right now, which is shut down completely, there doesn't seem to be any relief for people who are not in a position to bring their labor force back today and can't use them. I mean, that's what we were on the phone with the guy from the SBA, and he said they're looking for you to pay your employees for the 2 weeks after you get the PPP loan, and they don't care whether they're working or not. They don't care if all they're doing is substituting unemployment for this loan money. So I don't have the answer, but it's ridiculous. There's going to have to be something done for businesses that can't rehire their employees right now.
Right. Actual sizing of the loan, I think what you do is you look at 2019, you look at your payroll in 2019, you back out, and we'll get into it in a minute, but you'll back out taxes, federal taxes, and then you'll size the loan. You'll look at your average payroll. You look at your payroll over 2019, divide it by 12, and multiply that by 2.5. And I believe that's the size of the loan. You can't include people who are being paid more than $100,000. So they're included, but they're just capped at $100,000. But Scott, I think that the fact that you're a seasonal business is gonna cut the amount of your PPP loan down. All right,
Perfect.
so I'm going to keep going through the
dive right back into it, and we'll save these questions. I'll save them here. We can read them off here at the end. That way, we can actually get through all of them.
Okay. So the size of the loan, as I just said, is up to a maximum of $10 million, and it's 250% of the average monthly payroll cost. Initially, we thought that was a trailing 12. You would just look back from the date of the closing, but I think that the SBA clarified that on Thursday night and said, no, you're supposed to look at just 2019, the whole year of 2019. That's what I heard. Joe, have you heard that?
I don't know that. I don't know if it makes it. I don't know if you mean, in other words, going from 12 months from now back to 12 months.
Well, what I heard was that they're now saying you're supposed to look at January of 2019 through December of 2019.
Yeah.
That you're not supposed to just look back. Yeah, that's what I heard this morning. Again, nobody knows, exactly what's going on here, including the lenders. There's been a lot of media over the weekend about how the lenders can't even administer this program because they don't know the rules. The rules have been so unclear. But with respect to the payroll costs, it's broadly defined. Salaries, wages, commissions, like brokerage commissions are included. Cash tips are equivalent, which you could determine because your employees are supposed to be filing tax documents showing their cash tips. Group health benefits, retirement benefits, and state and local taxes assessed on compensation. You are supposed to back out the federal withholdings, federal taxes, both employer paid and employee paid. So if you're paying an employee $50,000 and they're withholding $10,000 or $5,000, you don't size the loan based on 50. You based it on the size of the loan when you deduct out the amount of their federal withholdings. So this slide where it says amount of loan, again, it's net. If you're a self-employed person, it's your net income up to $100,000. You exclude compensation over $100,000. You exclude federal payroll taxes and income tax withholding. You exclude comp for any employee whose principal residence is outside the U.S. And sick and family leave wages for which a credit is available under the Families First Corona Response Act. That's another statute that was passed a few days before the CARES Act. So if you are subject to that statute, you should let us know and we can give you some specific advice. But there's a lot of these statutes where you can't take advantage of both of them. The allowed uses for the PPP loan. So this is where things get really complicated, as Joe said, for the hotel and restaurant industry, because you're supposed to be using this money for your payroll costs. Most of the hotels, and this is only for the 8 weeks following the closing. So if you're a seasonal business and you're not even up and running, or you've laid off a bunch of employees, then technically you're not supposed to even take this loan. And again, I saw a promissory note this morning that had reps and warranties that you were going to maintain your payroll. The borrower is going to maintain their payroll. And basically, you're supposed to rehire anybody that you've laid off. Our clients are not, by and large, they're not doing that. So it's very problematic under the PPP. But if you're a group like my law firm, which we haven't laid off anybody, we can use the money for payroll, we can use it for health benefits, we can use the money for mortgage obligations, we can use it for rent, we can use it for utilities, we can use it to pay other debt. So if you can satisfy the workforce headcount requirements, which we'll go into in a few minutes, this is great. But if you can't, this is a problematic type of program. So debt forgiveness. So the real incredible feature of this is that what everybody's looking for is to convert this from a loan into a grant where you don't have to pay it back. Now, if it's a loan, the SBA lender will decide the term of the loan. It can be for up to 10 years, but we're seeing like 2-year loans or 3-year loans. The SBA lender can decide that. As far as the interest rate, under federal law, they can charge up to 4.75%. But what we're seeing is somewhere between a half of 1% or 1%. So these are very, very low interest loans. But again, the goal for most people is to have them forgiven. In order to have the loan forgiven, you have to think about a few things. The first is, are you maintaining your headcount? And what they do is they look at your full-time employee equivalency headcount over, you can choose a few different time periods. You can look at a time period in 2019, or you can look at a time period in 2020, depending on what's best for you as the hotel employer. So if your headcount was lower in 2020, that's the period of time you want to look at as your baseline headcount. And so you set the baseline by either looking at the time period between February 15th, 2019 and June 30th, 2019, or you can look at the period from January of 2020 to February 29th of 2020. You set that as your denominator, and then the numerator is the average FTEs that you're employing during the 8-week covered period, which is the period from when the loan closes and then 8 weeks forward. So there's another way that you can be negatively adjusted for the debt forgiveness. The other way could be if you hire 100% of your workforce back and you only pay them half of their normal salary, normal meaning the salary during that baseline period. So if you hire let's say 75% of your FTEs back compared to your baseline, then your debt forgiveness gets reduced by 25%. There's a pro rata reduction in the amount of debt forgiveness based on your head count. And then again, there's a second negative adjustment to the debt forgiveness, which is the actual amount of the compensation. So if you were to, on that one, there is a 25% buffer. So if you hire 100% of your workforce back and you 75% of what they were paid previously, so in other words, you give everybody a 25% pay cut, there is no negative adjustment to the debt forgiveness. See, you might go back for a second? So you have to look at those two different types of negative adjustments. One is your head count, which is your full-time equivalent employees, and the second is the comp of your workforce. So in this example, assume that there's a PPP loan for $1 million. Now you're just deciding off the bat, you're going to pay your legal fees and your accounting fees, which are not qualified expenses, your inventory, your reservation fees, those are all not qualifying expenses. So you're going to pay $800,000 of the $1 million will be qualifying. That will be your payroll, your debt service, your utilities, your insurance costs, your benefits. So you have $800,000 of qualifying expenses out of the $1 million, and then you're going to bring back 75% of your workforce, 75% of your FTEs. So then what you do is you multiply your $800,000 of qualifying expenses by 75%, and you end up with $600,000 of debt forgiveness. Now, the SBA has, they have calculators. The local lenders should all be able to kind of help you all figure out how much the sizing of your loan and how much could potentially be forgiven. Another thing to note is that the application for forgiveness is separate from the application for the loan. So you get your loan, and then after you get it, you apply for some percentage to be forgiven. So you don't have to make your decision when you apply for the loan about how many people you're going to bring back. There is this cure where if you've laid off people already and you want to bring them back, if you bring them back by June 30th, you're supposed to be able to potentially get 100% of your debt forgiveness. I don't think Joe or I really know how that cure is going to work. Joe, do you know more about this June 30th date than we knew last week?
No, but I just want to mention that, there is also a question as to whether you have to use the net pay as on the numerator and the gross pay as the denominator when you go to calculate your forgiveness percentage. And if that's true, then you're not going to get 100% no matter what you do.
Can you explain that?
Language. So if you look at the language where they talk about using, in the regulation, I think it came out last Thursday night, there was language that said you had to use payroll reduced by federal and state withheld income taxes and employee Social Security taxes, and that only applies to payroll after February 15th. So it may be that you have to use the net payroll as the numerator of the fraction, and the gross payroll, which is the prior year payroll, average monthly payroll, as the denominator of the fraction, in which case you're not going to get 100%. You're going to be something like, 75% or 70%.
Yeah, I've definitely thought of that. And so the advice that we're giving our clients is get as much as you can get as a loan. And then, if you may have to just hold some of the money back and then pay it back as a loan, because if it's not all forgiven, unless you want to have debt, which is fine. I mean, this is very cheap money. But if your concern is, well, right now we don't really know if we can get 100% forgiven. So in that case, our advice is to get the money, put it to the side, then apply for debt forgiveness. And what I've heard is that the SBA is pretty easygoing, and the lenders are pretty easygoing about approving loans. But we think that there's a high likelihood that they're going to push back when it comes time for debt forgiveness applications. So I think that the best strategy at this point is get the money and then don't spend it all if you can avoid it. If there's parts that you think may not be forgiven, hold on to it, apply for the debt forgiveness, and then if they say no, we're not going to forgive as much as you want, then you just still have the money to pay it back, or at least be prepared for there to not be 100% debt forgiveness and have money available, to pay debt service. By the way, it's 6 months of deferred debt service on this loan. So you don't have to pay even if it's not forgiven, you don't have to pay any debt service for the first 6 months. And then you can apply for additional debt service deferral. So it's very cheap money, and it's very flexible loan terms. But again, you don't know that you're going to get everything forgiven that you want to have forgiven. So be prepared to have to pay it back. So the application here, I mean, this whole process is a little dated at this point. These slides are a little dated. I haven't personally applied for a loan, so it's hard for me to say exactly what the process is. I've been talking to a lot of people who have, and it's not been a smooth process. I think that number one, if you want to apply for a loan and you haven't already, your best bet is to call a SBA lender that you have a relationship with. So, a lot of my clients, they have never applied for an SBA loan, but, they bank with XYZ Bank. So the first thing to do is just call your business contact at ABC Bank and say, I'd like to apply for a PPP loan. Are you guys participating in the SBA program? Many banks are. So if they say yes, at least you have a leg up because at least you have a relationship with the bank. They'll give you an application. You fill it out, you turn it in, and that's about as much as I can say about the application process. When these slides were done, it was before the regulations came out on Thursday. At that point, we thought that it would take 5 to 10 days to get approved. I haven't spoken to lenders this morning to see if they're still thinking that. But the program is up and running. A lot of people are applying. So I think everything kind of varies from lender to lender about how quick it is, how easy it is. Some of them are using their own applications. So that's really what I have to say about loan applications. Yep. Okay. So the second loan is the EIDL loan. So the EIDL loan actually I think is a little bit easier and a little simpler than PPP. But one thing to understand is that PPP is, you're trying to get that converted into a grant. The EIDL loans are actual loans. The EIDL loans can be for up to 30 years. The interest rate can be for up to 3.75%. So this is very, very cheap money. And of course, the feature that, everybody has heard about at this point is that you can apply directly to through the SBA website. Just go to sba.gov and you'll find your way to the order form. It takes about 10 minutes to apply for this loan. It's extremely easy to apply for. And you can get an emergency advance. It's $2 million cap. You don't go through any of that rigmarole that we were just talking about for the PPP about how many, what's your head count? You have to hire people back. There's none of that. So the feature that everybody has heard about is that they're doing emergency advances of $10,000 payable within 3 days. I think it's 3 business days. I don't think they're going to count the weekend. So, the way it works is that when you apply, they consider you for an advance. I don't know that each advance is $10,000. I think that when you apply, you put in, they ask you, what is your gross revenue for the past 12 months? They ask you some questions, and I think that they'll give you the $10,000 based on how you answer those questions. And I think it's up to $10,000. I don't know that they're giving everybody $10,000 left, right, and center. What we know for certain is that if you're turned down for the EIDL loan, the $10,000, you just keep it. You don't have to refund it, no questions asked. If they approve you for a loan, I personally do not know if the $10,000 has to be repaid at some point as a loan. What I've heard from several people is that it's not. It's that the $10,000 is just a grant from the government. So that's a question that we don't know the answer to at this point. I think I was talking about it with Joe earlier. I spoke to another accountant about it. Joe, do you know?
I thought it was. Can you hear me?
Yep, we can hear you.
Oh, okay, so I thought it was. I didn't think it had to be repaid either way, but.
Yeah. So so we don't know. I think you're right. I think it's just an advance that is just yours forever. But we're not 100% sure on that. You can apply for both PPP and EIDL. We're advising a lot of clients to do that. If you do get the PPP, the $10,000 is subtracted from the debt forgiveness. If you apply for EIDL and PPP and you get the $10,000 advance, then that $10,000 comes out of the debt forgiveness. You can't have both in that way, but you can certainly apply for both loans, and a lot of people are doing that. There are other loans part of this. That's part of the CARES Act. It's Title IV. We're not going to go into detail on this presentation about these other loans. They're for larger employees, anywhere from 500 to 10,000 employees. These loans have a lot of strings attached. You have to retain 90% of your workforce. You cannot issue dividends or buybacks, and you can't use the money for stock buybacks. There's lots of other requirements that we're not going to go into on this presentation, but just to let everybody know, there are other loans. So unemployment benefits, we're just going to go into this briefly. You know, the one of the more popular features here is $600 per week from the federal government. This is on top of whatever your employees might be getting from your former employees might be getting from the state government. The $600 per week is only going till July 31st, 2020. But we think, actually, can you go back for a sec, Steve? But we think that it might be continued. So the $600 a week is a terrific benefit from the federal government. That's on top of the state benefits. They've also expanded the program. All the state programs are going to continue through December 31, 2020. And they've opened up unemployment benefits to a wider range of workers, including self-employed workers and independent contractors. These are, you know, Uber drivers or, you know, gig economy type people who worked for themselves can now file for unemployment. So in this slide, the slide kind of mentions this short time compensation program that a lot of states have these programs where if you want to reduce the hours of your workforce, then your workforce can file for unemployment even though they're still working for the employer. So even though they're not laid off, if now everybody has their hours reduced by 50%, then they can apply for unemployment, and that program is guaranteed by the federal government. It's administered by the state. All right, so I'm going to turn this over to my friend and colleague, Joe Schulman, to talk about tax relief.
Hi, everybody. So, Steve, I'm on your slide that says tax relief.
Yep.
Okay, because I can't see. I'm not seeing it. I'm just doing my own slides here. So this starts off. This is going to go from least important to kind of the more important, give or take. And one of the things that is mentioned in the bill is kind of esoteric, but employers can make COVID-related payments to their employees. In other words, helping them work at home, to set up at work at home. Anything disaster-related that can be justified in a loose way as disaster-related can be paid to an employee without having to report that payment on the employee's W-2. And for some reason, they've decided this is the right time to let employers make payments directly on student loans of their employees or reimburse employees for student loan payments, similar to like they could pay for tuition for outside education. I don't think it's going to come up too much. You're probably all aware that the payments for the IRS payments in most states have now extended the filing deadline and the payment deadline for 2019 tax returns and the first quarter estimates from April 15th to July 15th, which creates a weird situation where the second quarter estimate is still due June 15th, and the first quarter estimate is now due July 15th. Most of my clients are just going to double up and pay it twice in June instead of having to pay it June and July. IRA plans, they're now allowing this very kind of liberal $100,000 withdrawals from IRAs, COVID-related, with no 10% penalty if you're under 59 and a half, and the opportunity to, instead of a 60-day window to roll that money back, a 3-year window to roll that money back. And if the money's not rolled back within 3 years, the tax gets paid over the following 3 years. So it's quite a liberal benefit.
And Joe, is that for 401ks too?
Yes, 401ks or IRA plans. Yeah, IRA qualified plans. Another weird kind of weird thing is that they are letting people who are required to take minimum distributions, which are people who have over 70 and a half, not take a distribution for 2020, which is particularly beneficial because the 2020 distribution is based upon the 12/31/19 value of the account, and the value of the accounts have come down so much. So in 2020, you can take out based upon the 12/31/20 value of the account. And the the general rule for loans from 401k plans was you could take up to 50% of the balance up to 50,000, and from March 27th until for 6 months you have a period where you can increase and take up to $100,000 on a 401k loan.
And Joe, can I ask you a question? So let's say somebody's taken a loan and they're being charged interest. It's interest to themselves, but it's interest of like 5%.
Right.
So
yeah.
Now, if you take a loan on today's date, do you have to charge interest in the same way?
So I think you do. I mean, it's kind of ridiculous. You think that you would just be better off taking a withdrawal and having 3 years to repay it. But some plans don't provide for in-service withdrawals. I can't imagine anybody taking a loan if they can get an in-service withdrawal. So if you have a plan, you might want to just, if you have employees that need the money, amend it to allow for in-service withdrawals. That's a good question.
Okay, cool. Thanks.
Okay. Tax credits for COVID mandated sick and family leave is a 100% tax credit. It's dollar for dollar tax credit up to $511 a day for 10 days for an employee who's sick. That's $51.11, and $200 a day, 2/3 of salary up to $200 a day for maximum of $2,000. But the catch is it doesn't apply if you get a PPP loan. And everybody's getting PPP loans, so I don't know who's going to take advantage of this. An employee retention credit, again, I'm not sure if this does not apply if you take a PP loan, so I'm going to go through it quickly. But if you either shut down your business, partially shut down, let's say 1 or 3 locations, or you have a 50% drop in sales from 1 quarter this year to a quarter last year, you're entitled to a potentially a $5,000 credit for employees who you keep on payroll, but it's limited to $10,000 of wages. I'll go to so I'm on the next slide that says, starts off by saying the business interest limitation. Is that, Steve, are we together?
Yep, we're right on it, Joe.
He's got you covered, yeah.
Okay, so I don't know if I'm talking to people who, if it's a hotel type, where people own hotels, actually own real estate in this or not, but if you do have property, like if you own real property and you purchase real property, you may be familiar with this interest limitation, which was a limitation that your interest expense couldn't exceed 30% of your adjusted taxable income. And this doesn't apply if you have sales under 25 million, unless you're a tax shelter and you have investors who receive more than 35% of losses from a partnership. Then this kicks in, and this is not so uncommon. We've seen this kick in quite a bit, and that limitation is increased from 30% of adjusted taxable income to 50% for 2019 through 2021. This is a somewhat esoteric. The repeal of the 250,000, 500,000 excess business loss limitation doesn't come up very often, but it has to do with the fact that you can't take a loss from one business that's over $500,000 and use it against other income. You're limited to $500,000. That's been repealed 2018 to 2020. So that creates an opportunity to file an amended tax return for 18 if that applies. You probably all have heard about the IRS rebates, where people that have income of a certain level are going to get checks of $1,200 if they're single, $2,400 if married, and in either case $500 for each qualifying child. That phases out between the income levels that you can see between 75 and 150 and 99 and 198. And then for people who don't itemize, which is basically people who don't have a mortgage, a $300 charitable contribution for non-itemizers. Okay, so this is getting more important. All employers can defer their share, the employer's share of the Social Security tax, which is the 6.2% portion, not the 1.45% portion. And that's for the period starting now until the end of the year. Josh mentioned that we have about 130 people. We have 130 people in our office in Braintree, Massachusetts, but we have about 1,200 people basically along the East Coast and somewhat a little bit in California, and we're going to defer something like $3 million in Social Security taxes, and that's an interest-free loan, and it's payable. 50% of it is due back on 12/31/21, and 50% on 12/31/22. So this is something that really almost every business, unless they have a really small payroll and it just doesn't amount to much, is really should consider.
Yeah, I mean, like, I just want
yeah.
to pause you for a second, Joe. I mean, like, a lot of these tax issues, like, if the conclusion is that the PPP loans are just not useful for hotel
Right.
owners, maybe
Right.
they should just do all this tax benefit, because here's
Well,
another one where you can't do it if you're getting a PPP loan.
Right. And I forget what you said earlier, but for people who are seasonal or who cannot be in business right now, I'm just not excited about getting these PPP loans because of the fact that you're forced to hire people that you could keep on unemployment. And I also think that it's a good chance that by the time you're ready to open up your business, there's going to be more money available for people like this, and you might and they might give preference to people who haven't gone through a PPP loan, and then you really get screwed. Anyway, this is important.
I mean, I know that if you're laying people off, then the payroll deferral isn't going to help you either. But some of these other tax benefits, where you can't get them if you do a PPP loan. If the PPP loan is so unattractive, you might as well get the tax benefit.
Right, and if you take a PPP loan and it's small, you might end up not being able to defer the Social Security taxes on a bigger payroll. It's just, you have to look at each case individually. So so up until 2017, traditionally in the tax code, you were able to take a net operating loss, a negative taxable income on your tax return as a result of business losses, and carry it back at least 2 years and get back taxes that were paid in prior years. And in 2017, when Trump's tax bill passed, that was repealed, and net operating losses were only allowed to be carried forward. So any taxpayers that had a loss in 2018 could not carry that loss back. And on top of that, they did, because of you're probably familiar with this qualified leasehold improvement technical mistake that was made in the bill, the bill was intended to allow landlords and tenants to basically take bonus depreciation and expense tenant build-out costs, or landlord build-out costs. And because of a glitch in the language, they weren't able to do that. And it finally took this pandemic for them to realize that they should correct this, and they did correct it, retroactive to 2018. So if any of you have bought property or basically put a lot of money into property in 2018 or 19, you can, with certain exceptions, if you expand the building and so forth, if you can expense that now as bonus depreciation, and if that creates a loss, which is not uncommon, that loss can now be carried back 5 years. So you can go back to like 2013 and start getting taxes that were paid in these early years, and not have to wait until you carry it forward to offset income in the future. So this is what the tax planning is about. Taking bonus depreciation, consider amending, or not, if you haven't filed 2019, claiming bonus depreciation in 2019. There's also the possibility that if you've never claimed bonus depreciation on stuff that was placed in service prior to 2018, you can do a cost segregation study, and you can catch up and take it all like on 2019 tax return. And then if that creates a loss, go back and get money that was paid in prior years. What's weird is that under this new partnership taxation regime that was, because of a law that was passed in 2015, any partnership some partnerships can elect out of this, what's called centralized audit procedures, and some partnerships can't. If they have a trust, for example, as a partner, or another partnership as a partner, they can't elect out. Those partnerships are not allowed to amend prior year returns. But those partnerships who do elect out can amend. So it's very complicated. And then, again, this might not apply to the hospitality business, But for businesses like accounting firms and law firms or manufacturers that have a lot of receivables, they can uh, consider switching to the cash basis. This is under the Trump bill, the 2017 legislation, to switch from accrual basis to cash basis, and again, potentially generating losses that can be carried back to prior years. And that's it.
Man, that's perfect. That's perfect. Wow. That's a lot to digest. Joshua, Joe, thank you guys very much. Now we can go ahead and open it up to some questions. I know Joshua's been fielding them as they've been coming in. Kirsten Giles asked, what do you think of, and Joe, Joshua, whomever wants to answer this one, what do you think the chances are that there will be another CARE or COVID-4 package released? The concern is if you don't apply now and the economy opens again at the end of June, the seasonal businesses will be left behind because people will think they can recoup their losses with half a season's work.
I'm happy to speak on that if you want.
Yeah, please do.
Yeah.
So I'm advising my hospitality clients to bet that they're going to have more relief. They're going to have to give relief to certain industries who are not going to benefit from these programs right now, and something's going to have to be done. And I honestly, so I was on a conference call with or a webinar type thing with someone who was a very senior person at the SBA, and he says the government doesn't if there's a crisis, there's no end to the amount of money that will be done to solve the problem. And I don't believe this problem is going to be solved, especially for hospitality, hotel, restaurant businesses by June. I just don't think that's going to happen, and the travel industry. And I'm sure I personally would bet that there's going to be more money available.
Awesome. That's a great question. Thank you, Joe. If for anybody else who has questions, over on the left-hand side of your screen in the upper corner, there are 3 buttons. The bottom button is the chat functionality. It will open something up here on your left-hand side. You can go ahead and type your questions in there. If you have a microphone, I can unmute you and you can go ahead and ask those if you want. But this way, we don't have everybody kind of talking over each other. So if you want to go ahead and type those questions in, we'll pause here for a minute. And since I'm not seeing anything coming through, Josh, is there anything else that you want to hit on for us? Otherwise, as questions. Oh, wait, here we go. All right, we have a Nevada payroll, which is agricultural workers year-round, and a California payroll, which is for our summer guest ranch. Can I file PPP only for my Nevada payroll?
So is it all in one entity? Are they both in one entity?
Everything is under the same FEIN.
It's a great question. I don't think so. I think you have to look at the total. I haven't seen anything that would give you relief.
Yeah, I haven't either. I mean, yeah, I think that they're going to be looking at the total head count and the total compensation of all workers.
And here we can circle back to these questions because I know there's just there's so many different variables here. You'll probably think of something and circle back to a question. So we'll feel free to fire answers back. Jane at Rainbow Trout asked, if someone has already applied for a PPP and then they decide not to take it, given what you have all just been saying, can we then apply for the tax benefits, et cetera, as described?
I think you can. I think it's only if you actually take the money that you get cut out of the other tax, that you lose the other potential tax benefits.
Boom. And Jane said, thank you. I was just looking for to unmute her. Okay. Any more questions in there? If there are no more questions, Joshua, Joe, thank you guys both very much. We really appreciate it. There's obviously so many different things here and it's constantly changing. Thank you from Matt and I, and all the ranches who are listening to this. It looks like we have about 25 ranch resorts who've listened to this. So I'll send you. I'll take this audio. I'll stitch it together with the presentation, and I'll send this out. Josh or Joe, is there a way? Is it all right if I share your emails with everyone? That way, if they have any questions, they can reach out. And with that, I'll go ahead and hand it off to you.
Absolutely.
Yeah, I mean, thank you so much for inviting us. Our emails are on the front page of the presentation and our phone numbers, so you can call us that way or email us. I do want to put in a plug at the end here for the state business interruption insurance bills. I think that the insurance industry is really getting off pretty easily here. There are no slip and falls going on. There's no auto accidents going on. They're making a tremendous amount of money right now. The banks are a conduit for all this stimulus money. But if you look around the country, all over the country, there are bills being filed, which is create basically like a 9/11 terrorism fund, but for the coronavirus, where the insurance company has to fund business interruption, which is a much better program than what we're looking with at the PPP, because the rancher would just get all of their payroll, all of their rent, if they have leases, they'd just be made whole to the limits of their policy, and then the insurance company gets reimbursed by the state, and then over a period of 5, 10, 15, 20, maybe 30 years, the state would do a surcharge back to the insurance industry, exactly like what they do right now for the Terrorism Insurance Act. So I would put in a plug for that. It's happening all over the country. And if it's not that, then as Joe said, I'm looking forward to some direct stimulus money from whether the state or the federal government, direct money directly to ranchers to keep them afloat. And none of this, you got to rehire, X percentage of your workforce, because as somebody said earlier in the chat, why would any employee come back if they're getting, unemployment benefits of 50 to 60% of their normal pay plus $600 a week? No one's going to come back. There's nothing in it for the business owners to force them to come back. They can't force them to come back if they wanted to. So I would encourage everybody to think about the business interruption insurance bills that are being filed around the country.
This is Matthew here. I do have one question before we go.
Yeah.
You mentioned that a whole bunch of those guidances and guidelines are still evolving. What would you recommend as the best sources to keep up to date on this?
I'm sorry, you cut out at the end there.
Oh, I was saying, since the guidelines are still evolving so much, what would you recommend as the best sources to keep up to date on all of these developments?
Well, if you're interested in PPP, I would say call your whatever bank that you're a customer of and get an application and apply and ask them for their interpretation, because I think a lot of what's going on is that the local banks are looking for clarification from the SBA. But I would, if you're going to apply with, say, Bank of America, I think that you need to kind of see how they're interpreting things as they are right now. And then, I think that what we're going to be doing at Sherin and Lodgen is we'll be doing an update to this presentation where we, in a few days, we'll say, okay, this is what's happened since our last presentation, and we'll try to highlight some of the updates and regulatory changes. So if you want to send me an email, I'd be happy to put you on our list, and then you can get whatever information we have. But like I said, what the banks interpret the regulations as saying is really the most important thing.
Perfect. Thank you.
Awesome. All right, everybody. Thanks for joining us. This was our second adventure story. Tune in for the next one. We'll see. I'll take an edited version of this and I'll send it out. If you guys need anything, as always, please call, email, message Matt and I. We're here to support everybody, and we'll get through this together. So bye now. Wow, what a fantastic webinar. Thank you, Josh. Thank you, Joe, for taking your time to do this. answer questions and present this information. We all know that a lot of the information seems to be changing, and there are a lot of different interpretations. We appreciate you being accessible and going out of your way to present all of this to us. So again, for everybody who's watching, this is Adventure Story number 2. Adventure Stories is a new series from Ranch Bookings where we interview industry experts as well as resort owners to get their best stories, advice, and practices. So we hope you enjoyed this one. Again, this was Joshua Bowman and Joel Schulman from the Sherin and Lodgen law firm talking about the CARES Act. We hope you'll tune in for our next adventure story. It'll be a really fun one. We're going to be interviewing Colleen Hudson. For those of you who don't know, she recently retired from the DRA and stepped down as the executive director, and she's pursuing, she's still in the ranch world and pursuing a lot of great things, so we're excited to catch up with her and hear some of her stories. So we hope you'll catch that one. Thanks for watching. Bye now.